All right, good morning, everyone. Good morning. Welcome today to our Alliance of Angels webinar. We're a Fireside Chat with Boris Wertz from Version 1 Ventures, moderated by Shannon from Seattle Bank. I'd like to start with some just quick logistics. We certainly want this to be an interactive session. So if you have questions for Boris or Shannon along the way, right, please feel free to use the chat to submit your questions, or you can also speak out. Don't be shy, right? So we want to make sure we get your questions in and we get your participation, so that this will be a kind of a fun session going forward with everyone participating. But if you are not speaking, right, we do ask that you please stay on mute, right? So I'm sure your dogs are cute and your kids are adorable, but they don't have to be part of our session today, just as a courtesy to everyone else. All right, so my name is Jane, and I'm going to just give like a quick Alliance of Angels. It is an angel group based here in the Pacific Northwest. It's in Seattle. There's 140 angels in my organization. Every year we put about 10 million into 20 companies. Most companies that are fundraising from us, they're looking for a total of between $500,000 and 1.5, and our typical check size is 250 to 500. Right, sector-wise, we're about a half IT, a quarter consumer, the rest is life sciences, hardware, energy, etc. Right, but otherwise, we are a sector-agnostic investor and a stage-agnostic investor. Our main hard filter is that we focus only on companies headquartered in the Pacific Northwest. And folks have asked now, given the current situation, right? So whether we are investing, but angels have actually been a little more active than I expected. We've done at least 6 post-COVID investments, and with several in active diligence. So activity has actually not really taken much of a hit. I'm sure that the new thing really has been making investments with entrepreneurs that we have not met before, right? Something I think Boris himself has recently done, Seattle company called Demand Star, right? So we're very much in business. If you are seeking investment for your company, feel free to send me a note. My contact information is on this slide. All right. And with that, I'm going to stop talking. I'm going to also stop sharing my screen. I'm going to hand over the session to our moderator today, Shannon from Seattle Bank.
Thank you, Jane. It's great to be here today. As Jane said, my name is Shannon Fajt. I'm a relationship manager at Seattle Bank. We're a boutique bank in the Seattle area focused on individuals, families, businesses, and community organizations and providing unique solutions. I am here today with Boris Wertz, very excited to be here. He's a founding partner of Version 1 Ventures and a board partner with Andreessen Horowitz. Prior to being an investor, Boris also started his own marketplace company that was eventually acquired by Amazon. So welcome, Boris.
Thank you. Thanks for having me.
Yeah, absolutely. You know, I'm not a founder or an entrepreneur, but I can imagine that it is maybe stressful to start a company or manage a startup even in the best of times. So I think it's really valuable that you're here today to provide maybe some advice or your perspective on fundraising or startups during this new COVID normal. Just kind of jumping right in, can you give us a lay of the current investment landscape in general? What are you seeing? You know, how has the ongoing pandemic impacted maybe round size, velocity of rounds, number of participants, deal terms, et cetera? Maybe what are you seeing in early stage investments versus, you know, later stage? What are you seeing out there?
Yeah, so it's really kind of interesting how the last 3 or 4 months have played out. I would say, you know, starting mid-March to roughly beginning of May and mid-May, everybody was a little bit in a shock, right? Everybody had to kind of figure out what is the new normal, what does it mean for the economy, what does it mean for certain verticals. I think most VCs have stopped, you know, kind of funding startups. But since kind of mid-May, I think feels like everything is back to normal in a certain way, right? And you know, a lot of deals get done at, you know, in kind of same valuations levels as before. You know, obviously not in the verticals that are directly affected. I know if you sell to restaurants these days, it's really tough to do anything. Or if you're a travel-related startup, obviously. But there's many other categories that are incredibly hot, if that is healthcare or if that is work from home, if that is e-commerce, everything that kind of is a direct beneficiary from the pandemic. And so it's kind of a little bit puzzling for us, because it feels like both public and then now private markets have kind of bounced back to levels that we've seen before the pandemic. And if you just take a general view of it, it feels a little strange that the world is in an equally good spot than before COVID hit, but that's at least what markets believe right now.
Yeah, no, for sure. So I did see that your firm didn't necessarily slow down in making deals during COVID. My understanding is that you're an earlier stage investor, having maybe more limited data to look at versus later stage. Do you look at marketplace, team, founder? Like, what's your general philosophy? Has that changed at all? Has anything about your evaluation process changed?
Yeah, I mean, first of all, I think as an early stage investor, we're very much focused on the teams, right? Certainly in an interesting market, working, kind of having developed an interesting product, but ultimately it's really about the strength of the team. We rarely invest on metrics. We mostly invest on the strength and complementary of the team. I think the other thing that is also kind of super important to note, as an early stage investor, we investing with a time horizon of 8 to 10 years. So, whatever going to happen in the next 1 or 2 years is not really relevant for our startups, as long as they survive, they have enough cash, they move forward and they build product, right? So it's a little bit easier for an early stage investor to kind of completely disregard what is out there in terms of the overall economy and challenges, because who knows how that's going to look like in 7 to 8 to 10 years when we're looking for an exit. So we're really looking for the people that are kind of mission-driven founders that are super passionate about solving a specific problem and want to build a company and want to build a big company over long term.
Got it. That makes sense. So I saw that you have done, like, those deals that you did get done, they were all over Zoom. Do you think, are you more likely to do deals over Zoom in the future? Or are you excited to get back on a plane and meet people in person? And then in that same vein, do you think, people being more comfortable with maybe remote evaluation, do you think it creates more opportunities for geographies outside of Silicon Valley?
Yeah, so we've done 4 deals in April, and we're kind of way ahead of the normal pace. And partly I think that was just lucky timing, etc. But partly because also we never really were worried about having to meet a founder in person. We certainly prefer it, but we've done deals and investments before that where we invested over Zoom. I think in general, more and more startups are now kind of starting to get, or investors getting comfortable investing over Zoom. And it's certainly, this is really the democratization of funding and in way more ecosystem. I think what we've seen in terms of the work from home movement, we see the same thing in terms of investing. Way more people are comfortable investing in places outside of the Valley.
Mm-hmm. That makes sense. So I know you said things have gone maybe more back to normal since May, but for a founder or entrepreneur who is pre-Series B, maybe raising a seed round or a Series A, what would you tell them to be aware of right now? What questions should they be asking potential investors? Do you have any thoughts around how an early stage founder should be thinking about maybe a convertible note versus a priced round right now?
Yeah, I think a lot of the principles still apply from what we've learned before in terms of, I think, avoid any unnecessary friction in the fundraising process, right? And if that means you raise on a sort of convertible note versus a priced round, if you're trying to just get around happening without a lead investor, whatever that is, I think, the same principles apply. I think that the one thing I would add to the current situation is just make sure that the investors you're talking to, they're comfortable investing over Zoom, right? I think there's a lot of people that still try to figure it out, and a bunch have no problems with that. But if you spend your time talking to people that just haven't done a deal over Zoom yet, and the partnership is not really comfortable, you might just be wasting your time talking to an investor that ultimately will not write a check in this environment.
Yeah, that's good advice. That makes sense. I know there can typically be an etiquette to raising money. When is the right time for a founder or entrepreneur to approach a VC? How should they approach a VC? Should they get an intro or reach out directly to someone? Like, how do you feel about that?
So I personally think like the best reach out is a combination of two things. Ideally, a strong connection, a strong introduction from a strong connection, right? Always helps. Usually should not be another investor that invests at the same time, at the same stage and has passed, but perhaps an angel, or kind of, if you're raising a Series A, then a seed fund, or just other entrepreneurs out of the portfolio. I think the second thing is just a super thoughtful way of pitching your company. I think most investors these days are very transparent about what they invest in, how they think. They publish blog posts, they're active on Twitter, they're active on Facebook, whatever it is. And I think understanding where people come from, what they're interested in, what they focus on, what their thesis is on a certain space makes a lot of sense, and kind of just improves your ability to connect with an investor, right? And unfortunately, I still see way too many kind of general outreach emails where it's even kind of, hey, version 1 team, I want to pitch you my startup. That usually as a cold email doesn't really get you anywhere, right? Yeah. So I think ideally a combination of a strong introduction and a very thoughtful pitch email. Mm-hmm. But we've invested on cold emails that were just super thoughtfully written to us, where you really felt the entrepreneur had put some time into pitching us and pitching his business and making the case.
Yeah, no, that makes sense. We want to see that. So I know there can be sometimes tension between people who are maybe working a more comfortable tech job, but they want to break out and start their own company. Do you like to see people make that jump before you invest, or will you consider somewhat, like, what advice would you give to people?
I think ultimately it's always a question of the entrepreneur showing the conviction that this is really a problem he or she wants to work on, right? And ultimately, leaving your job before you start kind of fundraise for your startup is usually a pretty big sign that you're super convinced you want to do it. You have that passion and conviction for it, right? Having said all that, if in some situations there's just economic limitations of doing that, right? And if you kind of show that you're still incredibly passionate and convinced that there's an idea you need to work on, but there's, kind of some economic limitations that forces you to kind of keep your job before you kind of start the startup. That's fine, right? But generally, it's a super strong signal that somebody has given up his job to pursue a startup idea.
Yeah, absolutely. I do want to pause here and just say to the audience, if you have any questions, I am monitoring the chat, so feel free to send those, and we can go through those if anyone has any questions to ask. So thinking more about like early stage companies, advice for founders, recruiting employees and finding customers is really crucial in those early stages. Like, what advice are you giving your portfolio companies about hiring and selling remotely or during this time?
Yeah, it's really interesting. We had a couple of companies in our portfolio before this whole pandemic hit that were completely distributed, right? And mostly forced to be distributed from the beginning on, because they were started in very small tech ecosystems, and there was no way that they could ever kind of build a major workforce, a major company in that ecosystem. So they had to kind of draw from the best talent from around the world to make it happen. I think that has become much more of an option now for everybody. I think to me, there's like two things I would really think through very, very specifically. The first one is to find product market fit, to build the initial culture, to really put the company on a really good path to scaling. There's nothing like being in an office together once we can do it again, right? Mm-hmm. So, I think the being remote is often something that is much easier once you scale past the first 10 to 20 people. You have a product that works, you can sell it, and then adding engineers to build out the product, adding salespeople to sell the product in a remote way is much easier than before. I think the second thing is what I think everybody needs to figure out is, even if you get beyond that initial phase of product market fit, there's some of these processes that kind of continue to develop the product roadmap, building culture, coming up with creative ideas, kind of having a really tight leadership team. All of these things still work much better in person than remote, completely remote, right? So while there's tremendous amount of potential now for companies to hire from anywhere, figuring out how to build a really strong company, really strong culture, really creative culture is not as easy as that is, right? And then, last but not least, you also ask about selling. I think selling, funny enough, I think that we're already way further along with selling remotely, right? Not meeting the customer in person, even for most enterprise products, both because a lot of enterprise products now go bottom up and have found a distribution channel that is viral in the first place. And then secondly, because I think much more people are just comfortable buying after a phone call or a Zoom. So that seems to be much further even before the pandemic.
Got it. That makes sense. I am looking at some of the questions that we have over in the chat. In this one, going back to the 4 deals that you did in April, how long of a relationship did you have with them before making a deal? What verticals were they in? I mean, do you prefer certain types of business models?
So it's really interesting. For the longest period of time, we were very focused on network effect driven businesses, and that mostly was social platforms and marketplaces. Over time, we invested more and more in SaaS, and where we saw strong data network effects around AI and machine learning. And just today, we actually announced that we're going to go much broader, right? Just because we feel like there's more opportunities beyond just businesses that have network effects. So my partner, Angela, she has spent a lot of time in healthcare in the last 4 years. I spent a lot of time in crypto and blockchain in the last 3 or 4 years. But I think ultimately what we're looking for is mission-driven founders that work on a really interesting problem in a big market, right? And that can be all sorts of things. And kind of the 4 deals we were mentioning before, I think perfectly represent that breadth of interest, right? We invested in a climate company. We invested in a online design collaboration company, so kind of much more SaaS play. We invested in a B2B marketplace, Demandster, out of Seattle, and we invested in a crypto company. So they're like very different focus areas. And ultimately, I think over time, we as a firm, we have always adjusted our interests and kind of looking at like what new technologies come up, what is really interesting, what are the most interesting people working on, and trying to kind of follow those trends and invest in those trends.
Got it. So I have a question here that says, can you expand on from your earlier comment when you say you look more at the team than the metrics? They say the team, I understand it's important, but aren't metrics a good indicator of a successful team? And I know you're in that earlier stage. Yeah. Maybe talk more about them, if there are any metrics that you look at that you can go off of. If not, yeah.
I mean, it's completely right. I mean, listen, like any funding round is always easier when you actually see a live product and metrics of that is working out. at the stage that we're investing in seed and pre-seed, often just companies haven't launched the product yet, or there are very few metrics, right? So for us, at the stage we invest in, most of the times we don't really have any metrics, and but sometimes we invest in early A's and kind of demand stuff. For example, out of Seattle was one. Dolly, also a Seattle company, we invested in their early A's. There were certainly metrics on there. But I think ultimately, when we think about seed, many of our companies have kind of ultimately scaled a different product than the initial product that we invested in. Some made completely hard pivots. So another Seattle company that we invested in is Eldridge. They started as a marketplace for developers called Group Talent, and then pivoted into sales engagement software called Outreach. Now, more than $1 billion valued company. But ultimately, this happens way more often than you think in pre-seed and seed, that it's slight pivots or hard pivots. And so ultimately, you're only going to get to the other side in a pivot if you have an excellent team that pulls through that, right? So so our focus is really on that team, and less about a specific product and metrics.
Got it. That totally makes sense. I have another question here that's more about VCs in general. Do you see them investing in innovative business models or mainly new tech? Have you personally invested in any innovative business model startups?
Yeah, I think what's going on in crypto and blockchain is actually probably one of the biggest innovations in business models, right? So one of the idea of a lot of crypto networks and platforms is it's the first time that you actually can have users and the participants in a network being rewarded with a stake in the network, right? And so before, when you think about large marketplaces or platforms, most of the value accrued to the central instance that managed the marketplace. When you think about Uber, yes, drivers got get paid, but compared to the value that got created with Uber, the central instance, kind of the company got most of that value from the marketplace. And so crypto and blockchain actually kind of come up with this completely new, different model where you can kind of reward users for participating in a marketplace, in a platform, by giving them the underlying token, and having them participate in the upside. So I think new business model is definitely something you can invest in. The kind of, but it has to come in usually it comes in waves, right? And the biggest wave that we see in the internet was offer something for free, right, and monetize it through advertising. I mean, that's really most of the internet got built through that. Google and Facebook and all of the social platforms got built in that way. So yeah, we're certainly interested in that, but it's usually more a wave of certain companies that kind of fit the zeitgeist of the moment. And we think right now, kind of the new business model innovation is probably mostly happening in crypto. Okay,
that's pretty interesting. I know the crypto or blockchain space is of interest of you. I have a question here, and to be honest, I don't know a lot about it. Someone asked, is blockchain too noisy?
I think, first of all, I think every single new technology gets very quickly very noisy, right? Okay. And I think it's just because there's a tremendous amount of interest from people around the world in finding the next big thing and kind of jumping on new technology. I think 3 or 4 years ago, everybody was pitching XYZ with AI, right? Or with a chatbot that is AI-powered chatbot, right? Before, kind of 2 years later, it was everything with XYZ on blockchain, right? And so I think, I don't think there's a single area where I would say it's not noisy. And crypto is no exception, right? I mean, there's certainly a tremendous amount of innovation, tremendous amount of participation in that space. I I feel like generally startups on the one hand side, I feel like opportunities have never been bigger to build $1 billion company in a very short period of time. At the same time, I feel like it has never been harder to actually break out of the noise, right? Because we feel like every single idea that is out there, within a few years, if not months, there's probably 5 or 6 other people and teams that are trying something similar. And it's not always evident how one can win over the other. Right?
Mm-hmm. Mm-hmm. What are some of the most interesting businesses or teams in this space to you right now?
In crypto?
Yeah.
Yeah, so I mean, we made a bunch of investments against this trend of decentralized finance, right? So on the Ethereum platform, people have started to rebuild the whole financial system in terms of debt, derivatives, equity, exchanges. So really, when you think about kind of the whole financial system is being built. Rebuilt on top of Ethereum, right? And the really interesting thing is that all of that is permissionless innovation, and people have started to build on top of the other protocols, right? And so suddenly it's kind of API layer over API layer, and each of the protocols becomes more useful and valuable as they're a part of a bigger ecosystem, right? And so we made 3 investments in that space. We invested in the leading decentralized exchange called Uniswap that powers about 6% of all token exchanges right now. We invested in a kind of mutual insurance built on the blockchain called Nexus Mutual. So they're rebuilding an insurance layer for on the blockchain. And the idea is really that everybody can provide capital. People can kind of pool their knowledge about certain risk to earn money on kind of calculating insurance risk much better. So it's really kind of a mutual insurance mutual on the blockchain. And then we also invested in a protocol called Open, which is building a derivatives marketplace. So we're very big on kind of this whole decentralized finance theme. But we have done other investments, for example, Flow Labs, Flow CryptoKitties here in Vancouver, which is kind of a blockchain gaming company. And so pretty broad interest, but decentralized finance is probably the biggest interest of ours right now.
Got it. So there's a question over here in the chat, sort of related, a little bit moving to another area. What are some of the challenges two-sided marketplaces need to consider when going to market?
So I think the biggest thing I would really think about is how the focus of supply versus demand shifts over time, right? And so the way we think about it is, usually to get into the market, you need to have a supply hack. You need to build up supply that is as unique as possible, right? Otherwise, you don't even have a chance to kind of get buyer interest, right? Because if you have the same supply as anybody else out there, it's going to be really hard to do anything. After you kind of build the initial traction, then everything shifts very quickly on a focus on the buyer side. Just because supply doesn't stay unique to your marketplace, it doesn't stay exclusive to your marketplace, right? If a category works really well, then these suppliers will go into other marketplaces that work. And so one example is, for example, after Etsy had created kind of the handmade category, very quickly Amazon went after all of those sellers, right? And try to recruit them for Amazon Marketplace because they felt like, oh, there's an interesting new angle on unique supply. We should have it for our marketplace. So for the marketplace, then it really shifts on how do you protect the demand? How do you protect the buyer side? How do you create buyer mindshare, right? And that is certainly a question of can you kind of get people to think of you as their primary destination for a certain product, right? Or a certain service, right? And so I think that is probably the biggest challenge I feel like for marketplaces, two-sided marketplaces. You need to figure out the supply side first, but that only gives you the chance to then hopefully go into the second phase where you will focus on the demand side and the buyer side.
Got it. So do you, again, looking at the chat, do you think timing is the most successful, like, or most important factor in a successful startup? And then, like, how does that play in? And then can you talk more about your early days of AbeBooks and how it kind of moved on that path to becoming acquired by Amazon?
Yeah, I think timing is super important for success as an investor, as an entrepreneur, right? And it's sometimes a little hard to figure out. You don't want to be too early in a market. For example, I mean, you look at augmented reality and virtual reality. We've been talking about that and getting excited about that for the last 5, 7, 8 years, right? And we haven't really seen any mainstream adoption. But even if you ride on a wave that goes very quickly, think about kind of the whole social wave. The first companies in that space, right? If that is MySpace or Friendster or Bebo, they didn't really become the Facebooks, right? Facebook was actually at some stage only number 5 in the whole social platform kind of market. But they figured out a few things like, real identity that really propels them to be the market leader, right? So timing is certainly a big factor. And, kind of that is a great transition to kind of the AbeBooks Amazon story, right? So we built up AbeBooks over a little bit more than 8 years, and was kind of the leading marketplace for used rare out of print books. And for Amazon in 2008, when we thought about selling the company, super strategic area because the books was still a big category for them. Secondly, ebooks hadn't really taken off at that time, right? And Amazon considered that they didn't want to have AbeBooks being owned by anybody else of their competitors, because we had a lot of unique supply from rare and antiquarian booksellers that they didn't want to have anybody else own. And so at the time they decided to acquire us. If you think 3 or 4 years later, Amazon had grown tremendously in other categories. The company had probably 4 or 5x by then, and ebooks had taken off. So physical books and books category in total kind of didn't really matter that much to Amazon anymore. And I'm not sure if they would have still acquired AbeBooks 4 or 5 years later. So timing, it definitely matters a lot. And for us, when we sold AbeBooks, it wasn't quite clear. We thought it was just a good moment to sell the company, less for those reasons. But ultimately, if we had taken it to market 3 or 4 years later, I don't think we would have seen the same result.
Got it. That's interesting. So about a year ago, you wrote a blog post. One, it had very interesting data about your fund's returns that few people are comfortable sharing. So I encourage people to read it if they haven't. Now that COVID has happened, do you think any of your core conclusions from that blog, either the timeline in which you get liquid or distributions of outcomes has changed with COVID? And feel free to talk about some of your core conclusions for people who haven't maybe read the blog. I just think it's when you talk about timing, kind of in the broad general level, are we going to see that timeline you talked about change at all? Yeah,
so when we published kind of our return multiples for Fund 1 a year ago, and I think what we wanted to show is how VC really works. A lot of people talk about it, but not a lot of people provide concrete examples, right? And so when you looked at kind of that fund, we did 20 investments. At the time we published it, like more than half of them were like zeros or kind of pennies on the dollar, right? So we pretty much lost all or kind of almost all of our money on those deals. But we had 4 or 5 deals that did incredibly well, from kind of a 5x to up close to a 50x, right? And so I think that the conclusion is really, VC follows a power law. There's a few winners that pay back for all the losses plus something, right? And ultimately, I think kind of that two conclusions out of that. I mean, for entrepreneurs is just, kind of, it is pretty normal that not every startup works out, and kind of investors are used to that, right? It's our model. For us as investors, I think the conclusion is we need to kind of invest in companies that can become these outliers, right? And so one of the sentences we always use internally is like, if we know how the movie going to play out when we look at a startup, then probably it's not for us, because when you know how something will most likely play out, most of the time there's no optionality in that startup, right? The optionality comes from, it's a massive market, you just don't know exactly how they're going to go at it and capture it, but there's a lot of optionality in certain strategic decisions you're going to take over time, and how you evolve your product roadmap and your product. So we're really kind of looking at companies that can become these outliers, and there needs to be some optionality, a lot of unknown in how they can develop. So, in terms of back in the day, or kind of a year ago, I said, a lot of the analysis was still on unrealized returns. We have actually sold a couple of companies since, but the winners and the ones that ultimately going to drive most of the returns for that fund are still out there and growing very nicely and haven't really had an exit. And partly, I think we're very patient investors. We want to wait for either a big IPO down the road or a big trade sale. So we are in no hurry to kind of liquidate those positions. I think the thing that also you learn very quickly once startups hit escape velocity, it is beautiful to see them grow so much faster. The 0 to 1 is an incredibly hard journey, right? The 1 to 100 is much easier, right? And still with its challenges and different challenges, but certainly it's much easier to get often from a $1 billion valuation to a $2 billion valuation than getting to that initial $1 billion valuation.
Interesting. So I have a question in the chat. Which is interesting, how do you perceive VCs who have never founded a company? Do you believe you have to have been a founder to be an effective VC?
No, I don't think so. And kind of funny enough, I say that despite having been an operator and an entrepreneur. I think there's very different ways of being a VC, and I think the thing that is the most important thing is there's three really important things as a VC. I mean, the first one is, I think you have to be clear that you're coach and not the player, right? You ultimately, entrepreneurs run the company. You can advise them, you can help them, but ultimately you're not taking the decision, right? And actually, that's a lot of entrepreneurs turned investors. They challenge with that because they were kind of the ones running the show and taking the decisions, and suddenly they're on the sidelines, right? I think the second thing is, I think as a VC, what you should really be is not an accelerator of moods of the entrepreneur, but kind of balancing it, right? If things go really, really well, perhaps you're the one that is a little bit more the skeptic, right? And provides kind of clarity to the founding team that challenges will come very soon, and don't get too overly enthusiastic, right? If things don't go that well, you should be supportive and kind of try to help them go through the phase, right? And so you shouldn't be an amplifier of moods. You should be really balancing them out. And last but not least, I think you should just need to provide very good advice at key central decision points, right? The reality is an entrepreneur has to take thousands of decisions every day, or at least hundreds, right? And he can't ask, he or she can't ask his investors for each of these decisions. They shouldn't be, right? But there's probably in every company's history, there's probably 4 or 5 key central decisions, right? Where I think it's a one-way street. If you go down that road, that has like long-term implications, and you just should make sure that you have the best investors around the table and partners around the table to take that decision, right? And so ultimately, a great investor is really good in all of these 3 things, right? But they can have very different backgrounds, right? Mm-hmm. And and former operator probably has more empathy in terms of the founder's situation. Perhaps he or she can sometimes draw a little bit more from past experience on which door to take in these strategic decision cases, right? But sometimes they might also be perhaps a little bit too focused on how they did it, how they took decisions, and not let the team kind of figure that out, right? And so I think investors come from very different shapes and backgrounds. There's no one path, but they certainly have to be good in all these 3 things.
Got it. That makes sense. Do you see any differences in the VC culture, and maybe even you can speak about the startup culture as well, in Vancouver versus Seattle versus Silicon Valley, or is a good investor a good investor, and you find these people in all markets? Like, kind of, what are you?
Yeah, I think in a certain way. So first of all, I think we've seen a lot of more great local investors pop up in many ecosystems outside of the Silicon Valley. Having said that, I think the Valley still has the biggest density of great investors, right? And I think the thing that has worked super well for the Valley is just these very powerful network effects, right? Of investors learning very quickly from other investors, investors having kind of better returns, which then gives them the ability and the confidence to invest in more riskier things, then ultimately drive even bigger returns and bigger outcomes, right? And all of that is a little bit less so in smaller ecosystems where the learning cycles are not as fast, right? The returns weren't as good, which then makes you kind of invest in what looks like safer things, right? And so ultimately, I think every ecosystem has to go through that dynamic of just getting to some density in investor levels. Having said all that, I think there's really 2 things happening. I mean, first of all, as I mentioned, like more and more really good investors are starting to focus on specific geographical areas, and I think you start getting that density. And then secondly, like 10 years ago, very few Silicon Valley-based funds would have said they want to invest outside of the Valley. They just didn't want to travel to board meetings. They didn't believe you could really build a company outside, a big company outside of the Silicon Valley. I think that has changed as well. So as an entrepreneur, you now have to pick up the litter in terms of if you have a really interesting company, you can raise from almost anybody in the world for your startup.
Got it. That makes sense. I'm looking at, so now let's see, looking at the time, we have about 15 minutes left. I'm going to open it up. I know we've had the chat going, but I've been trying to stick to questions that focused on maybe the discussions we were talking about. So if anyone wants to ask a question, feel free to do so. Trying to keep them maybe, a little more general, that would be beneficial for the entire audience to hear. If anyone has a question they would like to ask Boris, feel free to unmute and do so.
Hey Boris, this is Maria Karaivanova with Madrona. Just wondering if you can talk a little bit about your content strategy. You guys produce some amazing content that founders love, and kind of if you have any advice for anyone who's angel investing about that. And thanks for sharing all the insights.
Thank you, and good to see you again, Maria. On the content strategy, for us, it comes down to a few elements. I think the first one is, at some stage we realized that producing content, producing regular blog posts actually makes us better investors, right? Because it forces us to think through a certain theme, certain areas, certain dynamics, and writing them down kind of really helped us to really digest it better and kind of being able to explain it. I think the second thing that helped us is realizing that often our founders were asking the same questions over and over again, right? And so at some stage we realized, well, perhaps we just aggregate all of our knowledge around a certain area in what we call a startup guide or the marketplace guide, just because it felt like, it didn't really make sense to reproduce the same email over and over again to founders, right? I think the last one is, I think we trying to get as much help as possible with putting final touches on blog posts and guides. Producing content is a lot of work, right? And whatever you can outsource to experts, right? You can't outsource the original ideas, right? The original content, but there's a lot of in the process, from having an idea and having kind of a core thesis to putting in the final touches and having a really beautiful blog post or a beautiful startup guide. So you can really get help with that. So from our point of view, it's like, it helps us be a better investor. It helps us actually scale our advice to our entrepreneurs and beyond that. And we're trying to run it as efficiently as possible in terms of focusing what we create, like really on the original idea, and less like the production of the content in the end.
Great question, Maria. Thank you. Is there anyone else out there who wants to ask a question? I can go back to the chat.
Hi, I have a question. Boris, thanks for the all valuable info. Just want to get an idea, what are the size of rounds, let's say seed and Series A, that you usually go with? Like, what's the size of the check?
Yeah, so we invest in, so a typical pre-seed round is probably somewhere in the $750 to $2 million round, and we would put in roughly $500,000 in that. Typical seed round these days, $2.5 to $3 million, and we would probably put in a million. And then on an early A, let's say kind of a $5 to $6 million round, we would put $1 million to $1.5 million, right? So we're relatively flexible on the amounts, but depending on the stage of the business, anything from $500,000 at the lower end to $1.5 million at the higher end.
Okay, great. Then just a follow-up question: do you usually lead the round, or you kind of just participate?
No, I mean we love leading the round. Sometimes it might well be that there's already a lead in place, and they're just looking to fill the round. But generally, we love leading rounds, and we probably lead about 2/3 of all the investments we do.
Okay, great. Thank you very much.
Boris, a compliment to that on leading versus following. If you have a series of followers that are queued up, how do you look at leading in that particular sort of scenario?
Yeah, I mean, first of all, I think, so you assume like followers that were already with the company and kind of soft committed to the round.
Yeah, correct.
Yeah. It really depends a little bit on the situation. I mean, generally, I think when we try to lead, when we're leading, we're trying to put together kind of the best investor group possible, right? For that round, and sometimes we're helping the entrepreneurs with new introductions after we wrote a term sheet to investors that we like and like to work with. If that works, if among the followers that have already committed, there's some great value add investors, we certainly love them to participate. Having said that, often you have a bunch of followers that are not value add. They don't want to lead. They just want to sit around for something to come together. And that is often not necessarily the people that will be the most valuable and the most active and the most convinced down the road, right? So we're certainly looking at that with kind of an open mind. But ultimately the goal is to pull together the kind of the strongest investor group possible.
Appreciate it. Thank you.
Hi, Boris. Calvin here from Vancouver. My question is, you said if the best way to approach the investor would probably be through an intro path from, let's say, an entrepreneur from, let's say, one of your portfolio companies or an angel. But let's say you don't have an intro path like that and cold email is kind of like your way in. You did mention something along coming up with a good story. Is there some kind of structure you would recommend for a cold email?
So I think there's two elements to that. I think the first one is just, most importantly, like bring it to the point in terms of what you want to pitch, right? I mean, like nobody gonna read a one page email, right? I think you have to work, you know, the traditional idea, like elevator pitch, like what is the thing that you can pitch in 30 seconds, right? And the same thing is kind of holds true for a cold email. I think the second thing is that I mentioned before, like every single investor, or most investors, putting out their own thoughts on social media, through blog posts, et cetera, what they're interested in, how they're thinking about certain areas. And the more you can kind of understand how investors think and refer to that, perhaps some of the similar investments they made in the past, an area they're really interested in, have been tweeting about, et cetera, right? So, you know, if it's something that, you know, I give you an example. If you ran a gaming startup, right, and pitched me, I'm not a big gamer. I don't tweet about gaming. We never made a gaming investment. It doesn't matter how good your you know, kind of your cold email is, most likely, right, we're not gonna invest in that. It's not a fit. It's not something that we understand, not something that we're super interested in, right? But, you know, for example, I don't know, I'm interested in crypto. I'm like very public about it. If you run you're really interested in crypto startup, you can refer to, you can understand very quickly just looking at our blog posts and our tweets and my tweets, like, you know, how I think around crypto, where I think the opportunities are, et cetera, right? And if your startup fits into that, that's perfect.
Okay, thank you.
Hey, Boris, this is Raghu. I have a question on, is the cryptocurrency and blockchain and things like that, is that going to disrupt the VC business model itself? Things like ICO and things like that?
Yeah, it might well be. I think so. There's different ways. I think so I'm not sure yet. So let's take a step back. I think we've seen all of these initial coin offerings some time ago that didn't really work out. And I think in general, it's just very tough at the early stages for a retail investor to make a good choice about what startups might work out and what might not work out, right? And so, I mean, AngelList has tried that. We had a bunch of other crowdfunding initiatives. It's just very tough to develop it just takes a long time to become a good investor. I mean, somebody once joked, it takes 10 years and $30 million to become a good early stage investor, right? And the average retail investor will not have that time and that money to do that, right? So from that point of view, I'm not sure if like institutional VCs will suddenly be replaced by the person around the corner that suddenly starts investing in startups. But what is happening in these protocols is what I mentioned before, that one of the key business models is to hand out tokens to participants and users, right? And partly give upside away to these participants and users in exchange for their loyalty and their participation in building up the platform. and contributing to the success of it. And that by definition will limit the upside of investors in a certain way, right? There will be less value accrued with investors and more value accrued with users and participants, right? So I think crypto and blockchain in a certain way makes it tougher for institutional VCs to actually create big returns, right? But it's not because a different investor came in, it's more because the value distribution mechanics are different in that sort of business model than in the typical kind of SaaS and marketplace business model where you have a central company where all the value is accrued and also accrued in the hands of investors.
Thank you.
This is Mark. Could talk about crypto for the whole day, but a little bit of a different question. Being an investor in the Pacific Northwest and getting across the border from time to time while it was still possible, I found there's a difference between the investors and the entrepreneurs, both just between British Columbia and Washington. Is that only my impression, or what do you think? And if so, how to handle that?
Yes, there is. I mean, the reality is like Seattle is a 3x bigger city, right? And probably at least 10x, if not 20x bigger tech ecosystem if you account for Amazon and Microsoft and bunch of startups, right? So I think like entrepreneurs and investors usually get more sophisticated the larger the ecosystem is that they're working in, right? And the more opportunities they see and the more mistakes they can observe, right? And ultimately Vancouver is just a much smaller ecosystem in that way, right? So, that doesn't mean like there's like everything is average, right? But like if you generalize it, I would say like, the Seattle ecosystem is much bigger and much more sophisticated on all levels, if that is entrepreneurs or investors, and it really comes as a result of the size of the underlying tech ecosystem.
Thanks, Mark.
Thank you.
Let's see, we have a few more minutes if we maybe have time for one or two more questions. If there are any out there.
I'll just ask one question, Boris, regarding what do you think kind of like the interesting new markets kind of post-COVID? I know a lot of podcasts that I'm listening to, a lot of people kind of fishing for these post-COVID ideas. Any that you like, you that are on your radar?
Yeah, I mean, so I think there's a couple of answers to that. I think the first one is really everybody needs to decide kind of what is something that is just temporary during this pandemic and what is kind of a permanent shift in behavior, right? And that's not always obvious. I think there's a few things like, I'm pretty sure that work from home going to be much bigger than before the pandemic, but I don't think like we're going to see the same level as we see right now. Not every organization will going to switch to remote only once it's possible in that way. I think the second thing is a lot of the obvious categories, and we mentioned it before, e-commerce, online education, work from home, remote work, healthcare, etc. A lot of them have already players in them that just accelerated in this whole pandemic. And it might not be obvious now for a startup to kind of go after those opportunities, right? We have a bunch of companies in our portfolio that have just tremendously benefited from it. But I just don't think like any startup, like if they were the categories before and now they're like 2x the categories than before that, and it's going to be hard to figure out. But what I would really think about it in general, like I would think about two themes in general. I think the first one is what COVID in general has done is open the eyes to everybody that way more things can be digitized than we thought beforehand, right? And give you one example, like we have one portfolio company called Scanwell that does at-home testing, right? So the idea, you don't have to go to a doctor, to then go to a lab, then go again to a doctor. But basically you have at-home testing for certain conditions, and you get the immediate analysis on your phone, right? And then you can connect to a doctor, right? And so this thinking of like, what are processes where we still do something physical that has no value add? It just adds friction to the process. Like, what are these things that just, kind of, if you have conviction that that's going to change, and kind of COVID will be kind of this eye opener for a lot of people. Like, I think that's really one thing. And then I think the second thing is, I think counterintuitive is like, I think the thing that COVID has also shown how much people crave real experiences, right? And once that is possible again, it's something where perhaps it might not be as interesting to come up with another work from home startup where there's already 20. But what are actually startups that creating much better in person and kind of really personal relationships? Because what COVID has shown us that we really crave for that, and most of the tools are not really great in that way, right?
Yeah.
Thank you.
Boris, I think this is a great place to stop and a great question to end on. We really appreciate all of your candor and your insights. I think it's really helpful to our founders, entrepreneurs, and other investors out there. Jane, are you out there? I can turn it back over to you.
Yep. Yes. Thank you. Thanks again, Shannon, for moderating a great session, and also a big thank you to Boris, for spending an hour with us, sharing with us all your analysis and insights. It's greatly appreciated. And also thanks to the audience for participating and making this a great session and informative for everyone. All right. And so
thanks for having me.
Yep. All right. Great. So wish everyone a great rest of the week, and thank you very much for joining us today. Thank you.
Thank
Take
you.
care.
Yeah.
Bye. Thanks,
Bye-bye.
Shannon. Take care. Bye-bye.